All right, everybody. Thank you for joining me for this particular webinar this afternoon. Really kind of going to go over a lot of the information I talked about last week, as not a whole lot has changed yet, but there are some updates coming. I'm here in my home office, so if you hear a child scream or something bang, they are directly above me at the moment, so I apologize. If anybody has any questions, please feel free to type them in. Anything you want to ask me specifically, you're always welcome to give Mike or I a call. That way, and just excuse me one second here. Okay, there we go. You're always welcome to give Mike and I a call. The office is open. Technically, it's open right now. Mike is there, Sierra is there, and Adrian and Catherine are all there. We are going to be switching to more of a work from home scenario, because we do have a lot of work from home capabilities. So if we're still needing to do your taxes, or we still you need to submit our taxes, please call the office or email the office. We have online drop boxes available. If you're an existing client, we can use that shared document in the vault, and we can process everything online that way. So let's go ahead and get started here. And I just want to make sure we're showing the right screen. Yep, we're good there. So this is just so you know, everybody knows our staff here. That's pretty much everybody at this point. That's just Mike and myself, some of the places that we've appeared. You know, everything that I'm talking about is informational only. I'm going to talk about kind of where Mike and I think that the market is really going over the next couple of months, and kind of the steps that we have taken so far to get us there. Okay. Let's just put this there. Okay. So, you know, this is really just an update on the virus that's going out there. If we go back and we look at the markets and the past viral outbreaks we've had, going all the way back to 1981 with the HIV/AIDS outbreak, you can see that the 6-month change of the S&P 500 really only ended negative once out of all these scenarios. You know, we have the measles, rubella. The more recent thing was Zika and Ebola and MERS, all the way back to the swine flu, the avian flu, and SARS. All those things, after 6 months, that's really, you know, when we started to see positive movement out of the stock market at that point. Only once with the HIV/AIDS outbreak did it actually get worse over that time period. The measles and rubella outbreak there did end basically flat for the year. But for the most part, the length of time this has a true effect on the market has been about 6 months. This is unlike anything else we've ever seen before to this point, as far as we're shutting down a lot of the state economies. It's really much been on the governors at this point as far as what's going on, as Trump has really been trying to avoid having to do a nationwide shutdown. We take a look at the global stock market. This is the MSCI World Index, kind of showing that same scenario. Really what we see is it does have a pretty substantial pullback on the market. The most vicious one was the Ebola outbreak right here. We had 3-month return of negative 13.74%, and then after that 6 months it was 3.49% negative, and then it did end the year on a positive outbreak. So, you know, the viral outbreaks, the pandemics that we've seen have a rather short-term effect on the market for the most part at this point. And that's kind of what Mike and I are expecting out of this H1N1, out of the COVID-19 epidemic out there. So we go back and we look at the 1968, 1969 flu pandemic. It was really called the Hong Kong flu because it originated in Hong Kong. These are all numbers from the WHO. So this really told us that the virus began July of 1968. A couple months later, December of 1968 was when it became widespread in the United States. We saw our peak mid of, here's where it started to become widespread, and then the stock market really started to fall off here. And then a couple months later, the stock market, the Dow Jones started to pick back up, and then we did have a crash following that, but that was really due to the oil embargo. But really, this is the time frame that we're looking at here. This was about a 3-month period from when we saw our peak in the market to the bottom, and then finally its recovery was about a 3-month period. The Hong Kong flu, which was the H3N2, infected anywhere from 250 million to 1 billion people worldwide, and the death toll for that was 750,000 to 1 million. These are numbers, once again, that came from the WHO. I want to take a step back because I did get a question about how to prepare taxes. You can simply give the office a call before you get the Dropbox. You can call the main office in Hanover because Sierra and Adrian are there answering the phones. The number to the main office is 410-863-1040, 410-863-1040. And if you want to talk to somebody before your taxes are actually prepared, they will set up a time for you to have a conversation either with myself, Mike, or Andrew, as we are the ones who are preparing all the taxes right now because we're the only ones who have the work from home capabilities at this point. We go back and we look at SARS. Once again, this is really showing the overall impact on the stock market. The start of the pullback in the market was in January of 2003. That whole time frame lasted all the way until mid-May of 2003. So this is about a 5-month time span. When we saw the peak in SARS cases, right here is really when we saw almost the bottom in the market there. There are some certain sectors that do better than others when pandemics like this happen. Things like consumer staples and utilities, because people are still paying their power bills for the most part. People are buying food, clothes, things that they need to live on a daily basis. And in more recent history, people are buying a ton of toilet paper. So that is consumer staples, things that people spend money on regardless of what is going on in the stock market. Those are the more defensive plays when it comes to what you can do in the market to protect the money, but still have some market participation here. There was the start of the pandemic. This was the height, as I said, and then our ending of the pandemic really happened here. This is kind of when the cases tailed off. We go to the 2009 flu pandemic. This started in March of 2009. It originated in Mexico. This was the swine flu. It infected anywhere from 10 million people worldwide to 200 million people worldwide, and it killed anywhere from 100,000 to 400,000. Once again, these are all numbers that come directly from the WHO. Not everything is reported. They don't do a lot of confirmed testing for these types of things. They don't do a lot of confirmed deaths for this type of thing, like they are doing with the COVID-19, the coronavirus that we're seeing right now. But we can see here we had a peak in the virus here in the US. We still had a nice run up, and then we had a pullback in the market, and then a run up and a pullback again. Really the entire time frame for this it is about almost a year before we saw stabilization in the overall markets there. So this kind of gives us a time frame for when we think that the market the probability for the market to have some type of sustained growth, some actual growth in the market. Things are different now because of a lot of what's being shut down. So I don't really want people to take this as a very rosy picture. I really think that things are going to get worse before it actually gets better. So this is our 2008 recovery from March of 2009 when the bottom was all the way up here. So here is the coronavirus against the Dow Jones. 12/1/2019 is really when the first reported cases are assumed to have happened in China. These numbers were as of February 27th, 2020, so that they are off. But this is the data that I'm able to get that has a good track of these things. As they release new charts, I'm going to update my charts for future updates. And you can see really what's happened. The virus was first began December 1st. It wasn't reported for a month later. January 30th, 2020 is when a WHO declared it a public health emergency, and then we saw really the stock market just pretty much take a dive. Starting end of February, it started to come back. It fall down a little bit, but then really March is when we started to see that plummet there. When we go and we look at the total number of cases that were discovered in China, the update to this is that China has not reported any new cases in the Wuhan and I'm going to butcher the name, the Hubei regions, the regions that were hardest hit where this virus first came from. They have no new cases in those regions going back until Thursday of last week. Any new cases that have come up have only been imported cases. So those citizens of China who had traveled outside of the country and have come back, I want to say they had, out of the entire population of China, which is over 1 billion people, they had 34 new cases. And once again, those were all imported. So, from the start of where it really started to ramp up for them was January 21st of 2020. It took them, you can see the cases really ramped up very quickly, about a month for them from when they started all of their quarantine efforts, their social distancing efforts on January 21st of 2020, took about a month for the curve to flatten. That's a lot of what you hear Governor Hogan talking about, and the president talking about is flattening of that curve, people staying home, social distancing to limit the spread. Took about a month for that to happen. So their recovery really started 2/20. We're now 3/24, so it took about a month later for the cases to really die off, and that's kind of the time frame that we're looking at, is about 8 weeks from the start of all of the social distancing and the quarantining before the recovery really starts to happen. We have that flattening of that curve as far as cases go. So this is the Shanghai Index. Their market, this is really what it saw, and now that things have started to flatten out right here, they are starting to see a positive response in their economy. That's what they are reporting. So how much of this data really comes from the Chinese government themselves? How much of it is real? How much of it is made up? That's kind of one of the problems that we have with China. We can see the Shanghai Index started to fall off again because that's really when the U.S. pandemic started, and we are one of their larger trade partners. We're one of their larger consumers. So when we started having issues, their economy is going to have issues. So their first reported case was January 7th was when they officially called it. January 23rd was when their social distancing began. By February 18th, they started to have the rate at which cases were being reported started to drop. By February 20th, we saw flattening and leveling off of the new cases. And by March 1st is when we started to see the number of cases being reported to start dropping on a regular basis. So by March 15th is when they first started their manufacturing up. And the goal in China for them is to have all of their manufacturing, 91% of their manufacturing, up and running by the end of March. That's what they are shooting for. They aim to be allowing people to travel outside of that Wuhan and Hubei regions by April 8th. So they want to end their social distancing by April 8th. Based upon China, Italy, we're looking at Italy as to see if whether or not the timeline that Mike and I really have been looking at is going to hold. So the first report was January 29th. March 31st, their outbreak began. March 11th, we really saw a pretty big uptick in cases there. On March 17th, they really started skyrocketing. So they started doing all of their self-quarantine a couple of weeks ago. And just today, they actually had the second straight day of a reduced number of cases reporting. So they are starting now to see that leveling off, that flattening of that curve based upon all of their self-quarantine, government mandated lockdown. So that is working. So the total time frame is about 6 weeks from when they started their self-isolation, their self-quarantine, and their lockdowns to when it's starting to flatten. So if it all holds true, we should start seeing Italy start to come back to life probably in the next 15 to 20 days. That's what we're expecting. If the timeline holds true that we saw in China and what they're reporting is correct, this is what we should see in Italy. And that's going to be the key as far as what we see here in the United States. So, if we say that the measures the United States really started around the 10th of March, we should expect the pandemic to continue to spread, numbers to continue to go up for about 4 weeks. So we should see the flattening of that curve in mid to late April. It's important to note that the death toll in Italy is the highest that we have seen, but Italy has one of the highest populations, one of the oldest populations in the entire world at this point. They're one of the older countries out there, so they have a lot more people who are susceptible to this particular virus. So we expect there to be lots of volatility in the market throughout the end of this month, which will be the first quarter. The recession really has been confirmed at this point. We think the slowdown continues through the second quarter because I've been having this conversation with a lot of my clients. The numbers, the corporate numbers have not changed from the previous quarter at this point. Once earnings season starts coming out, corporations are putting out their earnings. We're going to see earnings are really going to drop off pretty rapidly. They're going to be slashing expectations, so the estimates for earnings are going to be cut, and jobless claims are really going to skyrocket. Those are all bad things for the economy. Once we start to loosen the restrictions and all of the quarantine and the social distancing and the self-isolation, there will be some pent-up demand out there, people wanting to go out and do things and spend money. My wife, God bless her, she's upstairs with my kids. She's doing the whole homeschooling thing, but she really wants to get out of the house. She would love nothing more than to go to some outside restaurant and let the kids play. People are going to want to get out of the house. The problem is it's not going to be a very rapid V-shaped recovery, more as a elongated U or a semicircle or an upside down rainbow is kind of what I've really been calling it, because once we start loosening the restrictions, people are not going to have as much money because they're pretty much going to be spending very little as they can as they tighten their belts over the next couple of weeks because either they've been laid off or they've been furloughed or they're just not working as much. And then people are going to be going out there looking for jobs again. And as the market starts to stabilize, people start spending money and people start hiring, the jobless claims will go down. And those are all good things for the economy. So we will have probably the recovery start to happen in the early summer is kind of what Mike and I are thinking at this point. So the Federal Reserve is going to continue their quantitative easing. They've been going back and forth on this this bill that they have, nobody can agree because politics have just become so party-centric recently that, it's either all about the Republicans or all about the Democrats. Either way, until they come to an agreement, there's going to be trouble. We're seeing a nice pop in the market because people think that this stabilization bill is going to happen. The federal government's going to extend the bailouts to middle America and the hardest hit industries. We just have to think about those industries in 2008 that saw the biggest pop after the bailouts. People are asking me what type of stocks should I be buying if I think this is a buying opportunity for me. Really, those companies that always have solid revenue streams, no matter what is really going on out there, they have seen pretty much a drop in their stock price because kind of as a rising tide lifts all ships, when the market just gets absolutely dominated and everything goes down, no matter how good that company is doing, the price of their stock is going to get dragged down by the overall market anyway. So right now, we're looking at cash and treasuries, short-term and mid-term and even some long-term, and gold and even an inverse fund as a hedge against the market. What the inverse fund does is if the market goes down, the value of this thing goes up. This is really what you can look for, protection against future drops. We've taken the bond portion of our clients' money. We did this last year or 2 years ago for a lot of our clients. And we took that safe money that they were supposed to have out there and we put in these fixed index annuities with these return of premiums. What they're saying is that stock market goes up, they go up, stock market goes down, you don't lose a penny. So that really has been a solid play on the market. You're able to take money out of where you have it now, put it in these things. After 2 years, you get back 100% of what you put in, plus some of the interest. You don't get to keep all of the interest, but it does allow you that market participation over the next 2 years without risking any more downside. So that's something that you could consider. If you want more information about that, just give Mike or I a call, and we'd be more than happy to discuss how that would really look for you and how it works in your portfolio. The number one thing we do for all of our clients is we make sure that income is secure so that no matter what happens in the market, your retirement income doesn't change. So you want to have a plan to secure that income for the future. Talking about buying stocks, create that wish list of stocks that you think that you want to buy. You want to probably start dollar cost averaging into the market sometime early May, June, where you're putting a set dollar amount back into the market, into these stocks over a 3, 4, 5 month period. So you're buying the same amount, you're putting the same amount into the market and buying varying amounts of shares depending on what the market is doing. Now is a great time to consider doing Roth conversions because the value of your IRA has dropped so much. At this point, for a lot of people, your IRA, your 401k, anything like that, we take that money now, we move it over to a Roth IRA, pay tax on a smaller number now, because if you've taken that loss, you want it to grow, you're going to leave it in the market. You want to have it back in the market when the stock market does eventually rebound. Why not have all of that money then grow tax deferred and have all that money tax free in the future? You want to think about loss harvesting. If you have highly appreciated assets, stocks that you've inherited, stocks that you bought years and years ago that have a big gain, think about taking some of those losses now to offset those capital gains for a better tax situation. If you own mutual funds in brokerage accounts, so I'm not talking about owning mutual funds inside of your 401k or owning mutual funds inside of IRAs or Roth IRAs. If you just have money that you're investing in the market that's not in an IRA or a Roth IRA or 401k and you're owning mutual funds, you have to look out. You're going to get whacked at the end of the year with taxes. Even though you've held your mutual fund through all this chaos, there are those people out there that went out and they sold their mutual fund in a panic. All we've seen for the past 12 years, 11 years at this point, is a run up in the market. Those mutual funds are holding highly appreciated assets. As shareholders are selling, those mutual fund managers are selling those stocks and bonds inside of those mutual funds, and they're realizing those gains. So even if you didn't sell your mutual fund, you are going to get a 1099 at the end of the year, just like you get every single year. that says, here's the dividends you made, here's the interest that you made. Oh, by the way, here's a ton of capital gains for you to pay tax on, even though you didn't do anything. So be mindful of that. Fixed index annuities are always an option out there. They allow you to participate in the upside of the market without risking anything on the downside. Like I said, if you're in cash at this point, you should consider dollar cost averaging back into the market in April or May. Pick an amount, set it in the market every single day. Every single month, that same amount going into the market. Markets really go up and down. The pattern always remains. If you're going to have money in the market, you have to be willing to take the good with the bad. The only way to avoid that is to use a fixed index annuity, but they always have strings attached. In exchange for that safety that they're giving you, that money has to be there for 2, 3, 4, 5, 6, 7, 8, 9, 10 years. You always want to have a cash reserve for any emergencies, in case anything happens like this. Don't try to time the market. I don't know when the bottom is going to happen. Timing the market never works out for anybody. At this point, we've made that transition into treasuries, gold, and inverse funds just to get out of the way of the market at this point in case it moves further down like some pundits out there are thinking. Like I said, no new local China cases, only 34 cases in the last 24 hours. They all came from overseas, which comparing to last year, there was thousands upon thousands of cases every single day. 91% of Chinese factories should be open by the end of March, and the Wuhan and Hubei provinces over there in China, the lockdown is going to end for them on April 8th. At some point, the Senate and the House are going to pass the stimulus. What it looks like, who gets the check, how much the checks are going to be, that's all yet to be determined. Most importantly, the federal government is now delaying the time frame in which you have to pay them if you owe money when you file your taxes. They pushed back that filing date all the way back to July 15th. They have pushed back the deadline to July 15th. Does this mean that you can contribute to your IRA for 2019 after April 15th? That I am not sure of. It has always been tied to the tax deadline. To be safe, I would say make your IRA contributions and your Roth IRA contributions by April 15th. If you're one of those people who makes quarterly tax payments, make that first quarterly payment by April 15th. It is much better to be safe than sorry and pay a penalty when we come to your taxes next year. And that is really it. Anybody with any additional questions, feel free to shoot me or Mike an email or give the office a call, 410-863-1040, to discuss anything in particular. Mike and I are trying to keep everybody as abreast of what's going on, what we're doing in the portfolios. We're trying to communicate through all avenues we have, whether it's using these webinars or our email newsletter, or even through Facebook. Mike and I have been updating our Facebook every single time we announce one of these webinars or we make a statement via email. So everybody stay calm out there, stay at home, help flatten that curve, and everybody stay healthy. But that is really it for now. Any questions, please give me a call, 410-863-1040. Thank you, and everybody have a good afternoon and a good rest of the week here.